Hello, this is Jordan. This video is being recorded on Tuesday, June 28th, 2022. Thank you so much for joining me today. Please like, comment, and subscribe. I would really appreciate it. In this video, I am going to look at what the market is telling us as far as when the Fed will stop hiking interest rates. So I'm going to run through some data, a few charts, some tweets, and that's what I'm going to look at and do a little bit of analysis. So it's not going to be a 100% analysis video. It's going to be looking at some current data and opining on that. So here, this is a chart from Bloomberg, and I thought this was Fed funds futures, but the data here is based on the swap market, so it includes some overnight index swaps and Eurodollar futures. And we can see that the white is basically the Fed expectation. The blue is June 27, and the other line was before the Fed meeting, the red line there. And so you can see that before the Fed meeting and then after the Fed meeting, you can see that the expectation for additional hikes, that decreased. And what's interesting is if you look at this chart, if you look at the blue, that's projecting a peak in the Fed funds rate. Let's call it February or March. We can call it March. It's hard to see. And interestingly, the white, that's the Fed expectations. These guys are always way behind the curve. They're thinking they're going to be able to hike rates through next year. Obviously, that's not going to happen. When you look at this indicator based on the market, the indicator tells you the Fed is going to be cutting rates in, looks like March or April. So that's the first chart to look at. Here's another one, which is just the Eurodollar market. And the implication from Eurodollar futures, you can see, is that the peak in the Fed funds rate, that's going to come in November, December. And so that's just above 3.5%, call it 3.6%. And so this market is actually, the Eurodollar market, it's projecting a rate cut in March of 2023. And basically the Fed stopping in November or December. So that's pretty interesting. And then finally, we have, these are some tweets I just posted here. The first one from QF Research, fantastic follow. If you're not following him, I highly, highly recommend it. And that is several days old, but that was several days ago. It was implying a December rate of near 3.5%. So if the Fed does 75 in July, we're looking at, 2.5 basically. So 1% higher. And so several days ago, that was showing Fed funds futures were showing a 95% chance of a Fed pause in December or February. We know that a pause basically means they're going to stop hiking rates. There's no way they're going to pause and then hike rates after that. It's just not going to happen given the way inflation metrics are starting to trend and these markets are starting to trend. Okay, and then other more recent tweets. Several days after that, this is yesterday, Fed funds futures projecting a year-end peak of 3.35%. So that basically comes out to a little more than 75 basis points after July. And then finally, another tweet here, which if next three meetings, if there's 75 in July and then you get a point after that, that would be 3.5%. So if we look at all these things, and then I'll go back, you can look at these. This is projecting a peak in February. This is projecting a peak in November, December. In the Eurodollar market in 2019, before that, 2018, before that, I think it was 2018. Yeah, the Eurodollar market was right in the last cycle. So I don't know enough. I'd have to look more into it. I don't know enough about that to say if it's a real leading indicator and it should be trusted. But last time it was way ahead of the curve and it was right. So that's saying pause in November, December. And that's what there's a high percentage chance of based on Fed funds futures. It's probably now showing a peak in December or February. So that's what the market is saying. And that's why gold has not moved yet, because this is not, the change in the market that we've seen in the last, call it the last 7 days or so, or the last 2 weeks, is that the expectations for the Fed hiking next year just completely evaporated. And so now we're seeing expectations that they're going to start cutting rates in, it could be March, it could be next May. And so that means they're going to stop hiking rates, a meeting or two before that. So, and so essentially for precious metals and gold, gold will start to move when it sniffs a Fed pause. And what I'm saying here is the Fed pause is still 6 months away based on all this data. So that's still too far away for investors and traders to unanimously want to bet on the Fed cutting rates in gold. But I mean, it's definitely a good thing that we've seen that shift. So what gold really needs is that we need to see a continued shift. We need to see the Fed funds, Eurodollar market, when they get to the point where they start to price in, maybe they could, maybe they're going to pause after September. And, maybe the expectation becomes only a 25-point hike in September. When you get to that point, the market, with respect to gold, is going to start to move. Gold is going to start to sniff that out. And then you'll see gold start to move. And then when it really becomes official that the Fed is going to have to pause in September, they're not going to be hiking in September. When you get to that point, that's when you're going to get a real move higher in precious metals. And then in addition to that, when you get the cut, that's when gold is probably going to move to an all-time high when you get the rate cut. And so now the rate cut is priced in, depending on what you're looking at, as early as March of next year and as well as May. So if these things continue to move to the point where the market starts to anticipate September, there's only going to be 25 or maybe even nothing in September. And based on that, you would, the market would probably be pricing in a cut for December, based on that trend of events. That's when gold will really start to move. That's when it's going to be positive for gold. So things are moving in the right direction, but we're not quite there yet. We need to see additional movement where the market is thinking that the pause, instead of the pause being in December, that the pause is going to be likely in September or November. I think that'll coincide with gold really starting to move off a bottom. And again, as that continues towards the market expecting a rate cut in November, December, that's when you get even more movement. And again, I'm repeating myself, based on the history, the rate cut should send gold to breaking out above 2050 or 2070, past 2100. But the market thinks that that's, 9, 10, 11 months away at this point. And so every day things are changing. We could have a bear market rally in the stock market, so we'll see how that impacts things. But ultimately, if there's more belief that there's going to be a recession and that we continue to see inflation come down, if energy declines more, if bond yields decline more, the curve gets inverted again, all these things are going to push up that rate cut into this year. From as it stands now, next March or May, all these things will push the rate cut sooner and sooner. And eventually, my guess, if you put a gun to my head, I would say they're going to cut in November. Maybe September is a little bit too soon. I think July is going to be the last hike and that they'll cut in November. That would be my guess at this point. So that's all for this video. I'm sorry for babbling on and on here. A lot of talking, but that's what the market is showing right now. And we'll have to review this as it changes. It's probably going to change in gold's favor. That's my guess. Thanks, guys. Leave a comment below, and I'll see you guys again in the next video.